Good morning, everyone. My name is Cameron Byrne. I'm the General Manager of Partnerships and Memberships here at the AFA. I'm excited today to introduce you to the webinar, Closing the Gap on Life Insurance Affordability, brought to you in partnership with iExtend. This webinar looks to address the issue of rising life insurance cancellations between the ages of 55 and 75, an issue which I'm sure you have all experienced with your clients at some stage. I would like to introduce you to our presenters today, iExtend CEO David Sarkis and Queensland Distribution Manager Mark Stubbings. David has over 30 years of finance industry experience across Australia, Japan and Hong Kong in managing multi-asset investment portfolios. He is a seasoned investment and derivative specialist with a global perspective and a hands-on experience in portfolio management, alternative investments and asset allocation. He has led and advised on implementing and scaling risk, technology and business development. He has held senior leadership positions at Merrill Lynch, Deutsche Bank and RBS, and more recently was the CEO of Silvertree Asset Management. Mark Stubbings is the Queensland Distribution Manager for iExtend. Mark has had a lengthy career in financial services in Australia and New Zealand. In particular, he has worked in a number of licensee, financial advice and product provider roles. Recently, he spent 5 years at Sun Super and then a year at Aware Super, where he designed, launched and further developed their respective offers to the IFA market. Mark is a qualified accountant and holds an MBA and a number of financial planning qualifications. Mark is also the State Chair for the AFA in Queensland. Before we begin, I'd just like to cover off on some housekeeping. Today's webinar will provide you with 1 hour of CPD, and the AFA will send details of your CPD certificate within the next week. We will answer questions at the end of this presentation, so please use the Zoom Q&A function, not the chat function, as per the diagram below. As a webinar attender, you will remain on mute throughout the session, so the Q&A function is where you ask your questions, which will be answered at the end of the presentation. I will now hand over to Mark and David. Thank you very much.
Thanks very much, Cam. And Cameron's already obviously introduced myself and David, but we'll be your co-presenters for today to run through a number of issues in relation to the iExtend offer. And the key part around iExtend is we're looking to solve an industry challenge. And that challenge revolves around the affordability and sustainability of life insurance. So let me give you a little bit of a quick insight before I run through today's program. First of all, this is a brand new innovation in life insurance in the industry as a whole. So hopefully prepared to be not amazed, that's a bit of an exaggeration, but interested in what is a very new innovation. And it's really sort of bringing to the front the idea of recognizing or structuring the actual cash or embedded value that exists in the number of term life insurance policies. And we'll obviously explain more about that. In simple terms, if you fit if a client fits the medical criteria, there is an opportunity for cash payments to be made to the beneficiaries on the policyholder's death without the policyholder making any further payments from this point of time onwards. All right, so there's a little bit of an idea of what we're going to talk about today with the iExtend offer, but let me run through the agenda today. So I'm going to invite shortly David to talk a little bit about our aspiration for participating in the industry. We'll talk a bit about our partnerships. We have some very distinguished partners that we work with. We can talk a little bit about the history of iExtend and where it came from. Then we're going to put a little bit of context around the Australian market, because I think understanding the scope and size of the industry is important. If all else fails, listen to what advisors are telling us, right? So we actually took the opportunity to engage with quite a few advisors, and we'll share some of the feedback with you. We'll then talk about how the iExtend idea works, and in particular, we'll then put that in terms of how that might benefit the clients that you service. We'll also talk further about some of the who are the likely clients that will qualify for the offer, and then we'll put a little bit of metrics around that with a case study so you can start to associate the ideas with the tangible benefits. After that, we'll talk about how it benefits the advisor, because obviously the presentation is heavy on the consumer benefits, and we get that, but there are some demonstrable benefits for the advisor, so we're keen to talk about that. At the end, we'll open the floor for Q&A, and it'll be the opportunity for you guys and girls to talk to us about some of the things that are on your mind. So David, maybe I can kick off just how it all came to be. So maybe you can give us a little bit of a sense of how the iExtend offer came to be.
Thanks, Mark. You look at, I think our relationship sort of a little bit deeper in terms of our industry experience with particularly one advisor by the name of Guy Mankey, who's been in the industry for quite a number of years. He has been thinking about this idea for quite a long time. I'm sure there's a lot of advisors out there have probably thought about it as well. And I guess it took that idea to sort of come to fruition when Guy and a number of the founders really got together and really decided that this had legs. And it had legs because I think one of the main points that we looked at was the demographics that we were witnessing today. So aging population. We've had probably about a good 30 to 35 years of solid life insurance growth, and obviously seriously a lot of successful sort of business being written in life insurance. And then we set out to sort of determine what was the size of that market that we could help. So we did a number of studies, worked with a number of actuaries, looked at, I guess, a number of studies in the market to determine whether this was something that could be valuable to those policyholders that needed it, and how big the cancellations were at that time. We'll go through that in a little bit of a few slides. But the real challenge was really just modeling a lot of this and really getting a good feel for the dynamics of, again, the industry and how we can help. And then we set about working to raise capital to make it happen. It is quite a capital intensive business, and we're quite fortunate to have found a real solid private equity family in Australia. They really believed in the proposition we had. We were able to articulate that to them, and they are extreme supporters of the benefits and the impact that we can make to the industry and to the Australian population in general. And with that backing, we set to build a team, and we've got an amazing team today, some really solid industry specialists from across the industry. Mark, you're obviously one of them. Been around for a long time. It really understood this and believed in what we were doing. And so we're fortunate we've got a massive belief in the team that this does create a massive impact as well. So with that, I guess we officially launched early this year when we started sort of publicising what we're doing. But really, it's been two years in the making and a lot of hard work in the background. So we're really proud of what we've achieved. As you said, it is first to market. The concept of something similar, particularly in the endowment space or whole of life space, does exist, particularly in America and somewhat in Australia as well. But to our understanding, no one's done what we've done here in life insurance specifically. So really excited to have been innovative here and being able to bring it. Ideas are great, but executing on those ideas and making sure you got longevity in those ideas has been, the foundations of, where we started and where we want to be. So very proud of where we are, very proud of the team we've built. And I think we're going to be very proud as well of what we can do for the industry and the people that we can help. So
cool.
Yeah.
And that leads very nicely into that, David. That gives us a bit of context and the idea this has not just suddenly appeared. There's been a lot of time and effort and thinking that's gone into this. But where do you see, in terms of the iExtend business, David, what's the aspiration? What's the vision for the business? Where do you see us sort of fitting in, and what would you like us as a business to achieve?
Look, we wanted to make sure that, any new ideas, any new innovation can sometimes be scary. And we wanted to make sure that that wasn't the case. We wanted to make sure we were as transparent as we can be. We wanted to make sure that when we developed this offering, there was a lot of thought going into governance, again, the social impact, the ethical impact behind what we do, and just really developing a platform that people understood and accepted and respected. And for that, we set out to want to be partners with everybody in the industry. We set out to, we honestly believe that the partnership is across the board. Policyholders who are advised by their advisors, and they're, while we don't give any advice and we don't engage with the policyholder, we feel that the benefit that we provide them will have a massive impact. And it's up to them, obviously, to determine that with their advisor. But we think that co-ownership agreement with the policyholder will be, a partnership that we have with them. A partnership with the advisor. Look, there's, and we'll talk about it a little bit later, but there's, it's the industry sort of transforming, and there's a lot of great advisors out there that are also transforming with that industry, and we feel that what we're doing is also helping them in a number of different ways, which again we'll discuss later. But there's an impact that we think we can have to the advisor community in a real positive way, and ultimately with the insurer. This is not possible without the strength of the insurance sector in Australia, we do see that because we are co-owning these policies and holding these policies, we do also need to partner with the insurer. So we've spent a bit of time talking to a number of insurers out there, meeting with them, trying to articulate what we do. And we honestly want to be partners with them and try to find a way that what we do can also help them. And look, it's early days there, and we can talk about that again a little bit later. But generally speaking, we see ourselves as partners with the policyholders, advisors, and insurers. And I think if we can all develop that shared vision and value that we can all bring to the sector, I think hopefully the sector will be better off for it.
And I mean, that's a huge theme of what you've said. There is that partnership piece. Do you think we've lost sight of that a little bit
as an industry?
Yeah.
Look, maybe even society as well. I mean, life's tough out there, right? And ultimately people need to look after themselves. But there's also the community aspect, in looking after yourself. How do you also look after the community? Because there's a beneficial impact that does come back to you. So it's possible, the world is tough and people are sort of trying to focus on how to best survive. But, I don't know. I mean, the industry is always transforming. As long as you can focus on what's best for it, I think it'll always converge back to the right path of trajectory. And so we're hoping this could add a bit of value. And, again, the industry is transforming in hopefully a positive way. It's been through a lot of ups and downs recently, but that will also settle and hopefully find the right trajectory.
Okay, cool. What I'd like to do now, David, is talk a little bit about some of the partnering arrangements that we have, because as the viewers will see on the slide that we've got up now, there's some pretty impressive firms that are involved with us. So would you care to chat a little bit about some of the various serious partners that we have with us in this enterprise?
Yeah, no, thank you. Look, we're extremely fortunate to have some amazing partners here. And look, there's different levels of partnership. Obviously, there's service providers that we've been very fortunate to partner with. And those service providers are some of the best in the industry. And so I think we've got an amazing access to systems, talents, people in the industry. We're also very fortunate to have been accepted by a number of industry leaders, associations, AFA being, the most prominent one that obviously we're on this seminar. But look, we're very fortunate that the associations and the advice community have accepted us. We've got some really great talent by way of administration. AFRM, we realised early on, and look, things might change, but at the moment the advice is that we are not a license, we're a private firm. looking to acquire an interest in life insurance policy. And for that, we needed to make sure that we had the right representation from a licensed capability. And AFRM, providing that administration service for us as a licensed entity. And Perpetual, who is our custodian, is also the other licensed entity that holds these assets in custody for ourselves and the policyholders. And so extremely fortunate that we've got two very strong names there who are licensed and who oversee that activity. And I can say that on a Perpetual basis, we're extremely fortunate. They're the best and largest in the industry. For them to have accepted us as a client is a great endorsement for us. But we don't take that for granted. We will make sure that we uphold everything that we do, but they're also upholding the interests of both ourselves and the client, obviously, in holding those assets in custody and dispersing the funds at claim time. So extremely fortunate to have Perpetual. But the foundations really for what we did is really the legal, the tax, the work that we did early on, and the actuarial work that we did early on. And so for that, we needed to make sure that every aspect of the offering had the best advice and was highly considered. So the actuarial work that we developed and the legal framework that we worked on, I think is best in breed. Cole McGregor and Peter Bobbin are industry legends there in that space, and we're very fortunate to have them. But Pete obviously did a lot of the structuring work for us early on as well, and we're very fortunate to have KPMG as our auditors to make sure that everything that we're doing is signed off on in the right way. So, all in all, again, very fortunate to have the best in breed in Australia supporting us and working with us.
Yeah, indeed. There's some very credible organisations and in particular some of the individuals you mentioned who have achieved almost lifetime legendary standard, which is pretty impressive. Yeah. So what I might get you to do, David, now is let's introduce that idea of I extend, where it starts to intersect with the consumer. So maybe I could get you to talk a little bit about where the I extend journey sort of starts. Where does it start to sort of intersect with the consumer? Yeah.
Look, we're very clear of where our position starts. Our position starts when the client, the policyholder, has decided to cancel their life insurance policy. We are not in the business of hunting down any policies that are in existence. We want to purchase in our offering those policies that have been determined to cancel. And typically that can happen in a number of ways. They can go to their advisor and say, we want to cancel, or they might call the insurer and say, we want to cancel, but ultimately a decision's being made. Now, we do not talk to the policyholder on their policy directly. We will always do that through their advisor or advisor that they have elected to work with. But again, the most important aspect here is that policy has already been decided to be cancelled. That journey starts at that point in time. And it's interesting because if you look at the available options that policyholders and advisors have always had for their clients, ultimately, there's a stage of how things progress, right? So the first stage is a renewal process, and what do people do? You either maintain cover and continue paying premiums, or if there was a decision, we can't afford it, what do we do next, right? And the options available to them at that point in time was to reduce the cover and therefore reduce the premiums. If that option wasn't enough, or if somebody really needed to keep that life policy because of health conditions and so forth, typically the third option was possibly to transfer that cover to a loved one or family member or friends or whatever. And that typically needs to happen anyone who has real serious terminal like conditions. It's really important that they are supported by the community and their family and friends to see how they can maintain that policy. But in all those three options, if they weren't available, the last option that was available for people is really just to cancel. And at that point in time, the policyholder and the beneficiaries would receive zero if they're, in the event of a death in the future. And so that was really the four options that were always available in the market. So what iExtend's done is created that fourth option. So at that point of cancellation, rather than the policyholder and beneficiaries receiving zero for those term policies, iExtend steps in and pays for all the premiums associated with the co-owned portion and shares in the benefits with the policyholders' beneficiaries. Now, again, we can talk about this aspect of, what we are co-owning, but essentially we do look at an assessment of these policies under a number of different scenarios. But ultimately, the people that do need to keep these policies the most are the ones that do have health conditions, but for various reasons have affordability issues and can't afford to keep paying them. So this is again where the co-ownership of that life policy with iExtend comes into play, and iExtend aims to eliminate future premiums to maintain that policy.
Excellent. And look, it's probably good now that we've launched that or put on the table that idea or concept behind why iExtend as a solution. Maybe it's good to look at the overall context of the Australian market, David, because we've had a look at some really interesting data that has come from a number of professional and research firms that talk about the size and scale of the market, and in particular the gap that in prospect this solution, the iExtend offer, can deal. So perhaps I can get you to talk a little bit about that context of the Australian market, in particular kicking off with that PwC survey that was done in 2017 and a couple of key points about Australians' view on life insurance.
Yeah, sure. Thanks, Mark. Look, yeah, we've studied quite a number of surveys out there. The ones that really hit hard for us and we took notice of was in particular this PwC survey. What was interesting there is that 78% of Australians viewed life insurance as extremely important. And that's wonderful because it means that either today or in the past or in the future, Australians will continue to believe that insurance is important, and that's a large number, 78. However, what was interesting there was only that 42% of those believed that life insurance will be there for them in the future when they need it, which is interesting because that's generally not what you enter into life insurance to do. So we felt there was that gap that we wanted to try to breach, maybe perhaps even changing the perception that life insurance will be there for you in the future in your time of need. And that's really the gap that we're trying to fulfill. So if we can improve on that 42% stat there, I think we've contributed quite tremendously to the industry. Okay.
There was also some very interesting stuff around just the entire scope and scale of the industry done by KPMG. So, mate, would you like to quickly just sort of touch on, particularly the sort of the collective sum insured, the size of the industry?
Yeah. Look, I'm sure these are numbers that the advisor community and industry knows really well, but it is a $1.3 trillion industry. It's growing, it's probably growing at a lower pace than what it has in the past. But the stat in 2018 was that there was about $24.7 billion of premiums that are collected over a 12-month period every year. We believe that number is probably closer to 26 today. So it is growing. It's growing due to a number of factors, really. It's obviously new life insurance being bought, but also premiums going up with age and indexation and so forth. But it's still a very, very healthy number. It's a massive industry, and I think it's quite daunting as a new player and small player of ourselves. I don't think we will will have a significant impact on those large numbers. But I think if we can make an impact even to the smallest extent of individuals that we can help, then we think we've made a material impact there as well.
Yeah. Interestingly, in the context of the size and scale of the industry, there was some disturbing information that came out of what policies actually lapsed during the course of a year, the actual value, and also the age demographic, the proportion that disappeared in a particular demographic. So do you want to just talk through that there, because that's quite concerning?
Yeah. Look, I think our understanding is that the average lapse rate for the industry in total is about 15% per annum. And we also understand that during COVID, that number fell to about 13%. It's possible that, I think the insurers did a really great job in trying to help and service their policyholders by giving them, holiday-free periods and so forth. So I think they were able to reduce that lapse rate over the last 2 years of COVID. But post that, I think it's gone back up to the average around 15. But to your point, the lapse rate for the higher age group is closer to 20-25% for the 55s to 75s. And that's a massive number when you consider the size of the industry. We're seeing probably around $18 billion of cancellations or reductions every year. That's a massive pool of individuals that have decided to walk away from their life insurance policies. And for the 55-year-olds, it's even possible that they may even need it for another 10 years at least. And the 65s to 75s, potentially again, also another 10 years, because, it's hard to know what people's positions are, financial positions or health conditions are like at any point in time. But, for the mass individuals who took these policies out 30 odd years ago, I suspect they always thought that they would be holding it for a long period of time, but for whatever reasons they are cancelling. It's quite a high lapse rate. And there's always different reasons why people cancel, really. But one of the main reasons really is that, and this is just natural, as part of the pricing of these policies, and it's a normal phenomenon in life insurance. As you get older, the chance of your life expectancy falls, and the chance of survival falls, right? And so as a result of that, premiums go up. And so we're seeing, if you look at that chart, it's quite daunting, the scale of the increase in premiums, particularly over the age of 70. They're really increasing at a rapid rate. And, for those individuals that have either retired or are no longer employed in that age group, that's a large amount of money that they would have to find to maintain those policies. And so, even with a 10 to 15% increase in premiums, and it's possible it's going to be higher for some insurers, premiums are effectively doubling every 4 to 5 years. And so that creates an affordability issue.
It absolutely does. And that was well explained. Thank you, David. Interestingly, what we've taken the opportunity as part of the iExtend business to get out and talk a lot about what advisors are thinking and feeling in relation to life insurance against that backdrop of information that David has shared with us. And we've been to a couple of conferences up in Darwin. Recently, the team went to both the Synchron and the AIOFP conferences. We've obviously been pretty active on social media, as I'm sure a few of the viewers would have noticed. At a business development level, we've been very active in the advisor community and with licensees. And it's interesting, we've been getting a fair bit of feedback from advisors. And I think some of the key points that we've got is that advisors have been saying to us that life insurance hasn't really changed. The fundamental design hasn't probably fundamentally changed for about 30 plus years. And there is a bit of a desire, I think, from an advisor's point of view, for life insurance to be more flexible, to better adapt to the circumstances of clients, but also to deal, as you've quite pointedly said there, David, to deal with that funding crisis. When you reach that age from 55 onwards where the premiums start to get a bit daunting, are there other alternatives if affordability really becomes an issue? So recently we thought we'd pick the brains of some industry experts, and we actually took the opportunity to pull together some luminaries, which included David Spiteri, a lot of the viewers will know. We also had Peter Sobels out of Risk Info, and we also called in Brian Perrin and Diana Percherek, who are both advisors out of Sydney. And they actually made some interesting observations at this industry roundtable. Brian pointed out quite a powerful statement that at some point in our lives we are uninsurable. Very, very true. But also Diana pointed out that there is still a feeling amongst clients generally, amongst consumers, that they often ask the question whether they're going to cancel their policy. Do I get something back as a consequence of not claiming? Or alternatively, when they end their policy, there is still a bit of an expectation that they almost get a whole of life style of bonus at the end. So there is genuinely some feeling that when it ends, they sort of, clients, consumers feel they should get something, right? So I think it's probably fair to say that there is a gap in the market there that we can look to address, which we'll obviously talk about more as this presentation goes on. But I think in essence, against that backdrop of feedback there, we actually genuinely feel iExtend as an offer can actually do better. Yeah. So David, what I might go to, what I might pass back to you now is to talk a little bit about through the nuts and the bolts of the issue, how the iExtend proposition actually works. So I might get you to kick off just with that co-ownership piece and what that means. Yeah.
Yeah, sure. Look, we've designed this to only look at life insurance, and we want to exclude TPD and trauma. The basic reason there was also revolved around, our ethical belief as to who we were trying to help and how we were trying to help. So having included TPD trauma in the offering would have meant that those that needed that amount of money at that point in time for a claim of TPD or trauma, would have been impacted by us, and we didn't want that to happen. So in all co-ownership agreements, what we do is we ask the policyholder to we ask that the TPD and trauma portion attached to the co-ownership portion that we take on to be cancelled, and that way it's very, very pure life insurance. What we also do is in the co-ownership agreement, we have a facility and capability for the policyholder to retain a portion in its entirety. So, for instance, if there is $1 million policy and the policyholder decides that they can afford $500,000 or $750,000 or whatever that number is, then they would pay for that portion of their life cover, which would continue to include TPD and trauma if they choose to do so. And we would take on the remainder of that, which we would co-own with them and pay for all the premiums on the co-own piece, but we would then exclude TPD and trauma on that.
Okay, cool. So what does under the co-ownership arrangement, David, what can the policyholder look forward to? Can you talk us through that sort of scale of entitlements, the economic bit? Yeah.
Sure. Look, we've looked at a number of different options and how we can structure this. The one that made most sense for us, and we feel for the policyholders, have a sliding scale that is paid to the beneficiaries based on the amount of time that we've spent together in the co-ownership agreement. Now, obviously, in a short space of time, a larger portion should go to the policyholder. So in terms of the dynamics, we look at this on a downward sloping scale and a percentage scale. So in the first year, if there's a claim, 60% of the claim would go to the beneficiaries of the policyholder. In the second year, claim will be 40%. Third year, 20%, and from year 4 onwards, it's 10%. But I must say that would include all indexation that goes with that policy. So, for instance, that table below that you've just pulled up is what we call the implied payout. And so, while there's an absolute guarantee of a 10% minimum payout, when you include indexation, that could be as high as 20+% in year 15. So just to give you a bit of a feel, we'll talk about this again a little bit later. We don't aim to have any policies that are very short dated in terms of life expectancy. Our average age of our book today is between 12 and 15 years. And that's kind of the zone that we think makes most sense for the policyholders and for ourselves, which means typically, we'll be paying premiums for the next 12 to 15 years. And so essentially, the payout for the policyholder, when you include indexation based on the current life insured amount today, could be as high as 20% plus.
And it's interesting, we'll actually touch on a worked example a little later, David, which will demonstrate that, because as you quite rightly say, it's a percentage based on the indexed amount, which can become quite significant. And I'll hope to demonstrate that when we do look to the worked example, right? The other thing from an advisor point of view is we're sort of very conscious that from an advisor's perspective, there's an awful lot of servicing challenges from a client and a business perspective. Education, qualifications, rising cost of servicing, increasing lapses, as we touched on back in the industry, are causing a lot of challenges and problems within the advice industry. A lot of what we're looking to do is to present another option to help fulfill that fundamental requirement around best interest duty, to introduce something that's actually hugely beneficial to your policyholder, your client. We're also looking to work with the industry, and I think David explained that pretty well in the past. We want to be part of the ecosystem. It's pretty important that we work with advisors and particularly licensees to make sure that we get the advice documentation correct as well. So we're very much here to help the client, but we also recognise that a very important part of that relationship is also the advisor. So we're very keen to work with the advisors and licensees to make sure that we do the correct thing from a financial advice and documentation perspective, right? Also, if a client enters into this co-ownership arrangement, we're looking to provide ongoing touch points to actually for you to continue to service the client, as we're assuming that's absolutely what you want to do. And we will look to provide regular reports around the value of the policy that's gone into co-ownership, how that co-ownership might impact on the broader financial planning piece, but also very importantly to provide a level of engagement and support to beneficiaries at claim time as well. So there are some very demonstrable servicing benefits for the advisor in relation to that client relationship. So David, what I might get you to do now is talk a little bit around this qualification piece. So what we're now going to do is put a bit of substance around the type of client. What would the client look like that might qualify for the co-ownership arrangement with iExtend, David? Yeah.
Sure. Look, there are a number of different metrics that we look at. Certainly, today, obviously, we're a newcomer and we want to try to service as many people as we can, and so we don't have a minimum sum assured or anything like that, or minimum premium. But we do want to try to help as many people as we can. There are a number of qualifications that we look at. Health conditions are one. The financial construct of the policy itself is another. So, the premiums and the sum insured. And typically this would work best for lives between the ages of, say, 55 and 70, 75 maybe, but certainly the older age group. So that's typically our focus market. What we do on the health condition side, what we're looking at there is really a change in health condition, and that's necessary because that's where we see the value, really, even for ourselves and the policyholder themselves. So when they took out that policy years ago, they were probably healthy. Some sort of conditions, health conditions have changed, and they need to keep it because of those health conditions. So we see those policyholders are the ones that we can help the most. But what we've done is we've tried to condense this concept of health conditions down to a score, say, between 0 and 10. And what we do there is we're saying, well, let's assume 0 means that someone's extremely healthy and someone with a score of 10 may have less than a year to live. And that's at the other side of the spectrum. Typically, I extend feels like the ones between 0s and 4s. Actually, if you go to the chart, the ones between 0s and 4s, they're the ones that probably are the most healthy, typically on close to standard rates. And they're or maybe higher, a little bit higher if you're a 4, but certainly for 0s and 2s at pretty much standard rates. Those policyholders typically don't need iExtend, right? So if they decided to cancel today and possibly try to get new insurance soon after, they should be able to get it pretty close to the same rates that they're getting today. So they don't really need iExtend. At the same time, we feel the 9s and 10s are not ones that we want to take on either, because we feel that it's important for the advisors and the community to try to help those. So that would be typically ones that have a life expectancy of less than 2 years. And for whatever reason, it's best that family members to try to help them, because then they can keep as much of that policy for themselves as possible. We see our pool being around that 5 to 8 in terms of health conditions, and certainly between the age groups of 55 and 75. And for us, it makes a lot of sense, both from a financial modeling perspective, but also from an impact perspective. They have changing health conditions, have affordability issues, and if they co-own with iExtend, then they get to keep a portion that they would have otherwise lost. And if we're paying all the premiums for them and their beneficiaries are getting something back for that, then we've done something that we think is good, but also something that works for us, because ultimately we need to also be in business to support other people in the future. And so part of this modeling allows us to do that. And I can say, and again, between the age groups, between the health condition scores of say 5 to 8, we're seeing life expectancy on our book of anywhere between 12 and 15 years right now. So I think it's probably the right scale in terms of, again, the modeling that we do, but also the impact that we can have for those individuals, and continue to pay premiums to the life insurance industry for, 10, 15 years is probably not a bad thing as well.
Oh, it's a very, very good outcome, and I'll touch on that a wee bit later as well. Thanks, David. What I'm going to do now is have a look at a little bit of a case study. So we've got a gentleman here who's, and we've used in this example, assuming that he's 60 years of age, and in actual fact, he's got $1 million worth of sum insured. His premium for this year is $8,000. The policy has an indexation of 5%, and we anticipate, given some of his health conditions, that his life expectancy is about 12 years, approximately. Now, there's a bit of detail on these charts, but what I'm going to do is just articulate some key takeaways. So the entirety of that policy is passed over to iExtend. iExtend is now paying for the premiums. At year 5, we've expended, this is iExtend, $60,000, but the policy is increased by indexation to $1.3 million. By year 10, we've expended $200,000 worth of premiums, but the sum insured has grown to $1.55 million. By year 12, which is the anticipated when the client might pass, that the premiums there are just over $300,000 paid by iExtend, and the benefit, if the policy was claimed on at that point of time, in total is $1.71 million through indexation. So the client's entitlement that started off at $100,000, so that 10%, has now grown also at 10% to $171,000. So the actual amount payable to the family, as David has already explained, has grown above 10%, proportionately speaking to the original sum insured. It's grown with indexation. So the families received a quite tangible benefit for having expended no premiums. And in actual fact, when you take that into account, the family has also saved $300,000 in premiums that they would have paid cumulatively to year 12. So the impact is quite dramatic in terms of the family's financial circumstances.
If I can just sort of add something that
absolutely you can, David.
Thank you. I would say that it's always difficult to talk about life expectancy. So in this case, obviously 12 years. It is difficult to ever know whether it's going to be 15, 20 years or something shorter than that. So it's just one of those things that on a pool basis, both the insurers and ourselves would look at. But obviously, at the end of the day, nobody knows how long or how short that's going to be. The interesting point here is I just want to clarify, because the savings is really on the portion that they would otherwise have kept. So in this case, it's an additional probably 90K on that portion that we are co-owning, and that could be quite material if they had to obviously hold on to that policy for a long time, not ever knowing where the claim would be. So we're taking that burden away, and hopefully that additional saving is of benefit to them as well.
Very good point, David. Thank you. Now, ladies and gentlemen, I'm very sort of aware that time is ticking on, and Cameron's already just sort of communicated to me that quite a few questions. So what I might do is just summarise the next two slides quickly, if I can actually get them to advance forward, which is proving a little bit difficult, I've got to say. Okay, all right, we might have to improvise here because I can't seem to move the slides forward. Okay, what I might do, ladies and gentlemen, is at this point in time, I might take time out, given that there's a slight practical difficulty, and I might call Cameron in at that stage to maybe share some of the questions. Cam, might be a good opportunity, given the technical difficulties, given that there's a lot of questions. Maybe I open the floor for questions, my friend. Yeah.
Actually, Mark, if you don't mind, I can just talk through the next slide, which might segue into some of the questions that are in the Q&A.
Okay.
If that's okay, Mark.
Yeah, please.
Yep.
Okay. So look, this is probably one of the more important slides. The last two, obviously. The benefits that we think come to the way of the advisor. And there's been a question about commissions and trail commissions and so forth. We see the benefits really for the advisors in being two main areas, right? The main one is, effectively the best interest and the benefit that they can offer for their clients. That's a really important one, and obviously one for the advisors to consider. So the client satisfaction, the ability to retain the policy, and so not being sort of recorded as a lapse, I think it should be a benefit as well. But the trail commission, it's an interesting one. We've spent a lot of time talking to dealer groups, licensees, and so forth, and there's a varying range of expectations around trail commission. Our view is obviously that it's up to the licensee and dealer group as to what that should look like. Our view is also that commissions and trails should be paid for service. That's just the industry standard. What that means obviously is ultimately up to, again, the dealer group and the advisors to determine. We've got some standard range of outcomes that we think we can work with the dealer groups and the licensees on in terms of what we think works for us, but ultimately it's going to be up to yourselves and your licensees and your dealer groups as to what that looks like. All we can say is that we believe there should be a continuation of some form of premium trailer coming your way, but we can talk about that more specifically on a one-to-one basis or at a dealer group level. The other thing that we think is really important in terms of the benefits is the longevity piece. We think what we've created here is a synthetic whole of life policy. If you think about it, whole of life was around 30 odd years ago. There was always a savings component and a payment at the back end. Term life today doesn't have that, but what we think we've created here is for no additional cost to the policyholders inside the council, a component that comes at the back end. And it's like, as we say, it's like a form of whole of life component. So we believe we've created that. But in creating that, we think it's really important to note that in doing so, you've probably kept the client on board in some way. So there should be a benefit to the community, the advisor community, in terms of the longevity of the client, the relationship that you maintain, possibly a relationship that you maintain with their friends, families, beneficiaries in the future in providing this. So we'd hope that the benefits to you not only are the continued servicing arrangement and the trailers that come with that, but also the relationship that you continue to have with your client and hopefully their community in the future as well. Yeah, that's the benefit slide.
Thanks, David.
If you can't see the last slide is really about the industry itself. I just want to quickly touch on that. Look, it's a complex question because people have been asked, how does this impact the industry? How does it impact insurers? And I do say it is a complex matter because a lot of the modelling that's done is something that we're not privy to. I mean, I would say just at a high level, when term life went from 65 to 99, I presume there were assumptions made by the actuaries that, with the higher premiums that charge for that, there should be some ability to recoup that over the life to 99. Obviously, there's lapse rates that are assumed along the way. But I think there's a couple of subtle positives that we think we can add here to the industry more generally. One part is that we think we're going to be pretty small. I mean, we're only trying to help a small segment of this market. We talked earlier on the second slide that there's about $26 billion of premiums that are received every year by the industry. And so if our vision is to help maybe $25 to $50 million worth of sum insured every year, that's a really small fraction of the 26 billion that's in premiums that they've received. And I think of the problem in terms of how does this benefit or impact the industry. I look at also, there's a number of areas to think about. That one is obviously longevity and life tables and so forth. But the other part of it is more around, what the industry is going through. So for instance, there's also the side of the asset side rather than the liability side. The investment returns that the insurance industry is receiving on that $26 billion of premiums that they're receiving every year. So if you can think about it on a simplistic basis, if they improved investment returns by 1%, that's an additional $260 million worth of revenue against an impact of 50 mil that we're going to be continuing to pay for over 10 to 15 odd years as well. So there's an asset side and an investment side that needs to be considered. The other side, I think, in terms of the impact is, if we can demonstrate that what we're doing will have a positive impact on the industry and that insurance will be there for those that need it most at that point in time in the future. I wonder where it changes people's behavior about life insurance, whether people would take up life insurance at an earlier stage and improves the number of sold policies at an earlier stage. So we'd hope that the impact will be more life insurance sold rather than maybe the stagnant levels that we have today. So, again, it's a complex problem with how it affects the industry. One of the comments that we had from a senior member of one of the life companies was, look, it's very hard to know what that impact's going to be, possibly not going to know for another 10 years. But I think there's a lot of softer components to this in terms of maybe more sold policies or possibly looking at this from the asset side where they continue to receive premiums and the retention rate is better. Maybe that helps as well.
Cool. Thanks, David. Cam, over to you.
Thanks, David. So just apologies for the technical issue here. I'm not sure what's gone wrong, but the webinar will be available on our website next week. So you'll be able to view those past couple of slides, I think you mentioned, Mark. So some questions are coming through, which is good. A couple have been answered. It is for life insurance only, and commissions will still be paid to advisors. Just looking at some other questions. How do you continue to fund insurance premiums that are paid through super past the client's 75th birthday, or can you take over a life insurance policy in super? as no further contributions are allowed. Is there a way
Yeah.
to switch your retail policy ownership from super to non-super?
Yeah, I think the short answer there, Cam, is that if the policy currently sits within superannuation, so it's in the superannuation environment as opposed to the ordinary environment, what we can do is effectively cancel that policy from inception. Most life offices allow that. Reissue as an ordinary policy. We can then deal with the policy then. We can't deal with it, unfortunately, when it sits in the super environment. Yeah.
Yep. Another question, is it just the ownership that transfers?
The short answer is yes. And David touched on this a wee bit earlier, that Perpetual are really the custodian. Yes, the ownership transfers, but it goes into a custodial setup with Perpetual. And we sort of thought that that was probably the best way to make sure that the respective rights of the parties are enshrined and respected. Yeah.
Yep.
So that's what actually happens, in practice. Yep.
Does the client need to go through, some good questions coming through, does the client need to go through underwriting before you'll accept the transfer or not?
Correct. And it's not really an underwriting process as such, Cam, not in the sense that you undergo an underwriting process to acquire life insurance, but we certainly do look to gain some information about the client's medical condition. And that may involve talking to the client or getting permission to talk to the client's medical attendants. Yeah.
Yep.
What we don't do, Cameron, is we don't ask for any medicals to be done if they haven't already been done. So all we do is kind of qualify the information that's out there today.
Yep. Okay. And just one last question in the essence of time. What if the client wants to cancel in the future? Once the policy is co-owned by you, can this be done?
The short answer is, and there's a couple of answers to that. Often what will happen is the client doesn't necessarily want to give us all of the policy. Yeah. So a circumstance could occur where the client has, in the example we used, $1 million policy. Yeah. But they may choose to retain and pay for $500,000 of that cover themselves. So ergo, we only take the other 500,000. They might at some stage in the future go, hey, look, I don't want to now hang on to this 500,000 that I retained. Can I pass it over to you? I extended. And the short answer is yes. Yeah. The second answer to your question is, if the policy passes over to us as a co-ownership arrangement, the client at some stage in the future can't then cancel that policy, no, because effectively it's held subject to an arrangement, obviously, and we've been funding the premiums for the last few years as well, Cam. Yeah.
Thanks very much, David and Mark. I think it's a challenging, conversation that advisors need to have, as you do with advisors and life insurers, to make sure they fully understand what I extend are out to achieve with clients and their insurance policies. On behalf of the AFA and our members, I'd like to thank you for this great webinar today. I know you'll, want to be out there in the marketplace having these conversations, and we look forward to seeing this offering develop over a period of time. So thank you to iExtend, thank you, Mark, and thank you, David. And the webinar will be available within a week or so on our website for those that have asked a couple of questions, and CPD certificates will follow in due course. Thank you very much. Have a great afternoon.
Thanks, Cameron. Thanks, everyone, for listening.
Thank you.
Thanks, FA. Thank you. Bye-bye.
Ta-da.